Welcome to Nexgen Software Services. My name is John Novak. I'm the developer of the software. We're really excited to have you with us. We know why you're here. You want to make money day trading, and Nexgen is here to help. And what we're going to do for you, we're going to teach you how to recognize the absolute best possible trading setups, and you're going to have unimaginable consistency. And you're going to do that through reading the indicators and accurately trading the indicators. And the objective for what we're going to do with you is for you to be able to take a small amount of money, like $3,000, to trade one contract in the market, which we'll talk about in a minute, and to be able to average $400 a day. And if you do that over the course of 20 trading days, you're going to be able to take $3,000 and make around $8,000 a month profit. And again, as you do this and you can do it consistently month after month, then you'll be able to start trading a larger number of contracts and making a larger monthly paycheck for your day trading. Again, a lot of work is going to go into it before you start making money because you're going to start on a simulator and we're going to work our way through an educational process. And we've already defined everything that you need to do from A to Z, from learning the trigger and Fibonacci reading to simulating trades to participating in class to retrading the day. To repeating the process and ultimately getting yourself down to where you can personally guarantee yourself that you're going to win when you start trading live money. And we're going to do it with a very simple concept. Buy low, sell high. And again, you've heard this a million times probably if you've been involved in the market. Buy low, sell high is a great concept, and that's how you make money. But not everybody can tell you exactly what low and high are, and that's where Nexgen is going to excel. And again, when we say buy, again, just very simply for definition's sake, a long position is when we're going to buy the market with the expectation that the price of the asset or commodity is going to go up. Same thing, again, we want to just talk terminology for 2 seconds. Going short or selling or taking a short position is selling something first and then buying it back later at a lower price. And we'll talk a little bit more about that in a minute, but again, think of it in terms of the house that you're in, right? Or that you've bought or that you've sold. Common sense dictates that you buy your house and you sell it for more than you bought it for later, right? That's how you make money on your house. And, there's some things that you go through when you're looking. Is it a buyer's market, seller's market? If it's this, you do that. If it's this, you do that. And ultimately, what you want is to be able to form an opinion about the market, the cost of your house, the value of your home, so you can make smart decisions buying and selling. And if you go back and you take a look from 1990 through 2020 and you look at the housing market index, quite simply, if you bought when prices were lower and you got out when the prices were higher, you made money. And then when the prices came down, if you bought some more houses and then you sold them on the way up, you made more money again. And we're going to use this same concept when we're looking at the market. We're going to define the direction and momentum of the market, and we're going to quantify these things by using our indicators, and we're going to generate odds for ourselves for a particular outcome. And when we have sufficient odds that the market's going up, we're going to look for a support area to buy, and then we will get out at a resistance area. And we're going to make a profit by knowing which way the market's going, the probability of winning, and knowing where the areas to buy and sell are. So we're going to do the same thing when the market's going down, right? So if the market's going down and we can quantify that we have enough direction, strength, and momentum in the market by looking at our indicators, we're going to look for a resistance area to go short, and then we'll buy that commodity price later. Again, we trade futures. If you guys are familiar with the Chicago Mercantile Exchange, That's where they had the pits and everybody was yelling and screaming and buying and selling. And again, they've been around forever, and this is the exchange where most of the futures contracts are traded in America. And just to give you some perspective, I pulled up their websites. And last year in 2019, they made $4.9 billion, round number, in profit, gross profit. They're doing something right. But more importantly, Nexgen has been involved in the business for, 23 years now, since 1997. And just over the last 15 years, you can see the trend. And number one, how much money they make. But they make money when people trade the market. And when you see this upward slope over the last 15 years, there are more traders today that are taking charge of their own trading and their own executions. And it's very important that you have a well thought out plan and a business model so you can make money. And the exchange also does a really good job of putting together information that you can go search out yourself on the Chicago Mercantile Exchange group, and the things that they feel are important for traders. Understanding the chart type, understanding moving averages, trend patterns, technical patterns for tops and bottoms, support and resistance, Fibonacci work, oscillator work. And these are all the things that Nexgen has already done for you. And not only done, but we've perfected these things. So the only thing you have to do is actually worry about when and where to trade them. So again, in our trading plan, it's a basic overview of what you're going to do and when you're going to do it and how you're going to do it. And the exchange and the brokerage firms determine the cost of each market to trade. So again, when we say, that your objective is to make $400 in profit for a day, we're talking about trading one contract on the exchange. And the trading is actually done, and you're going to hear this. Again, I wanted to cover terminology real quick. NinjaTrader, who our software resides in, is the brokerage firm and the trading platform. Now, there's some other brokerage firms you can trade through as well, but NinjaTrader will do the actual charting and data, and then our software resides inside of NinjaTrader to do the actual analysis for the software. So, again, the exchange is the CME, the broker and the charting platform is NinjaTrader, and they set the cost to day trade a contract. So this is the intraday margin for day traders. So you've all heard of the S&P or the Dow Jones, right? So, or the NASDAQ. So to day trade an S&P E-mini futures contract, the cost is $500. They also have a micro contract. If you want to start really, really small, you can trade a $50 contract. And we look at the S&P a lot every day in our chat room. That's why I'm telling you about it. One of the other markets that we watch predominantly is crude oil futures. Everybody's familiar with crude oil, but you may not be familiar with crude oil futures. The cost for us to day trade one contract is $1,000. And what that means for us, and again, I'm going back to the exchange website, they, the exchange and the brokerage firm, will let you trade the value of 1,000 barrels of crude oil for $1,000. So if crude oil is at $50 a barrel, essentially they're allowing you to trade $50,000 worth of crude oil for only $1,000, which creates leverage. And what this means for us is right here in the minimum price fluctuation. So 1 cent, or 1 tick we call it, or 1 price fluctuation, for us is going to be worth $10. So if we make 20 ticks, or 20 price fluctuations buying and selling, we're going to make $200 on one contract. And remember, our goal for the day is $400 a day. So we really need to make 40 ticks on crude oil. Now, one of the things that people ask a lot is, how do we trade $50,000 worth of crude oil for only $1,000 in margin money? And again, that's what they've established. We're not going to take delivery of crude oil. We're just going to trade it during the day, and then we're going to have no position at the end of the day. So I made this little graphic. Don't laugh at it. It's kind of silly, but it really explains selling something you don't own. Because a lot of people are not real familiar with how to take a short position and sell a commodity that you don't actually own. So I use this little example where you have a car, sports car, and this gentleman wants to sell it, and this lady wants to buy it. So she says, hey, I want to buy your car for $90,000. I'll pay you $90,000. And the gentleman says, hey, that's great. Thank you. Give me $1,000, and I'll hold the car for you for 48 hours while you get the rest of the money. So I won't sell it to anybody else. Right? So she's basically making a promise with $1,000 that she's going to pay him $90,000 total. Now, she knows the car is worth $100,000. So during this 48-hour period, she already has a buyer, another buyer, who's willing to give her $100,000 cash. So she says, hey, give me your $100,000 during the 48-hour period, pays the gentleman the rest of his $90,000, and keeps $10,000 for herself. So what she has done is she has actually bought a car for $1,000 down, sold a car that she didn't yet own, but she had the right to sell because she owned the right to sell the car. And again, this is what we're really doing with crude oil. So she's controlling the $100,000 car with only $1,000. And we're doing the same thing with crude oil. We're controlling $50,000 worth of crude oil, but we're not really going to take crude oil. We're just going to trade it and be done with it before the end of the day. That's why we get such good leverage, because we're really trading $50,000 worth of money with only $1,000. Now, leverage is one of the things that cuts both ways. So again, we want to make sure that we're on the right side of things and that we have the best possible trade setups. So if we can get 40 ticks out of the day on one contract, we're going to reach our objectives. Now, just to give you some perspective on the S&P and crude oil. So this is the S&P daily chart, and I put a little average down here at the bottom of the average daily range. And the average daily range from high to low on one day is over 25 points. It's even much higher than that now, but you know, the low end was 25 points. The upper end is, you know, after this last week of volatility, it's really skewed a little bit, but just call it 25 points for an average. So what that means is on an S&P future, remember, it's only $500 to day trade one S&P future. So, and if 1 point equals $50 in profit, right, we need 8 points for our $400 in the day. And if the normal daily range is 25 points, then we only need a portion of the daily high to low. Now, the benefit of, you know, day trading and intraday trading is that during any one given day, the market could go down 20 or 30 points, and then it could go up 20 or 30 points, and it might even do it 2 or 3 or 4 times. So instead of really having $1,200 potential, we end up with a market that has $2,000, $3,000, $4,000 in potential for the actual range during the intraday time frame. So again, for us to be able to make $400 is not really that difficult. Same thing with crude oil. Again, remember crude oil futures, it's only $1,000 needed in your account to trade one contract. And if 10 ticks is $100, meaning, you know, 57 even to 57.10 is 10 ticks, we really only need 40 ticks in a day to reach our $400 profit on one contract. Now, the normal volatility is at least 120 to 140 ticks per day from high to low on any one given bar, which again is a lot. It's over $1,300 potential. In much the same way the S&P goes up and down intraday, crude oil does the same thing. Crude oil can go down 100 points, up 100 points, down 50, up 50. So doubling or tripling that range, giving us ample opportunity to be able to reach our goals and objectives. Now, if you've ever traded charts or done charts before, you're probably familiar with something like a 5-minute chart. And I want to talk about bar structure a little bit because that's, again, the first thing on that exchange list. And I want to show you how we do it, why we do it, and why it's important. So this is a crude oil chart, and it's a 5-minute chart. That means that no matter what, every 5 minutes there's going to be one new bar. And the bar, high and low, represents, contains all of the trading that happened in that 5-minute bar. Some are bigger, some are smaller. What we're able to do with NinjaTrader is we're able to change the structure of the bar itself. So we can take the same data that's a 5-minute chart and we can say, I want to see that data displayed as a range bar with 8 ticks worth of range for every bar. And when we do that, it changes the visual of the data. So it's still the same crude oil data and the same, trades happen, but we're displaying the price data differently. So instead of one bar every 5 minutes, this is one bar every 8 ticks from high to low. So 8 ticks, 8 ticks, 8 ticks, 8 ticks, 8 ticks. So it creates a little bit more symmetry and the charts are a little bit smoother. Now what we've done at Nexgen is we've put together a Nexgen dynamic Rinku Bar. And again, this dynamic Rinku Bar seeks to smooth out the price data even further. And what it will do is it will display the bar structure that we're going to use on a daily basis, and you're going to see a lot of. And the reason that we do this is because the smoother the data, the easier it is to form an opinion of what might happen next. So when we look at any one bar, just to kind of give you a quick example, this is an 8-2 bar. And you'll hear us say 8-2 chart, 14-2 chart, 5-1 chart. And all it means is that the body of the bar is 8 ticks. And then if the prior bar was up, it only takes 2 more ticks to make an up bar. So every time we make 2 more ticks going up, we make an up bar. And then finally, at some point, we're going to make 2 times 8 ticks. So we're going to make 8 ticks down and then 8 ticks down again, which is 16 ticks. And then we'll start making down bars. And then if the prior bar was down, it only takes 2 ticks to make a new bar. And then ultimately, it's going to take more than 16 ticks to make a reversal bar. And again, the only purpose that we're explaining this to you is because this bar structure is going to be instrumental in our trading plan, and it's also going to be instrumental in our Fibonacci support and resistance and our trigger lines, which are going to help us form the opinion of what should happen next in the market. And when you know what's going to happen next, most of the time, you can position yourself profitably. So, number 1, support and resistance. Again, I'm going to give you a real short tutorial on Fibonacci because I believe wholeheartedly the more you understand about our method and why we do what we do, the more confident you're going to be in your trading of our software. Fibonacci uses thousands of pivots of support and resistance, and it's dynamic, and it's measuring the market itself and giving us support and resistance, turning points and breakout points. And I'm going to show you on the chart here in just a second. Our trigger line indicator is a linear regression moving average that uses the current market strength or weakness. So it's a visual display of the momentum of the market. So first, let's take a look at the bars. You remember our dynamic Rinku bars, right? And I want to talk about something that's an absolute, right? The high of the move and the low of the move are called pivot points. That's what we call them, highs and lows. And the highs and lows are absolute. And the only thing that is true is that at the high, no other person, algorithm, system, fund, anybody on the planet was willing to buy this commodity at a higher price, and that's why the market went down. And that's very important to understand. Nobody on the planet was willing to buy at a higher price than this price. That's very significant. When the market was going down, nobody on the planet was willing to pay a lower price than this one right here. And all of these major pivots that you see represent psychological, emotional, absolute highs and lows. And what happens when we use Fibonacci, and for those of you that know Fibonacci, you know that if you use the absolute low and the absolute high, Fibonacci ratios can predict bounces or reversals in the market. And there's different Fibonacci numbers. We're not going to get too deep into it, but 38%, 50%, 618, and 786 retracements. Generally, the bigger the Fibonacci number, the more powerful the reversal quality in it. So smaller numbers bounce, bigger numbers reverse. Just remember that. And again, we can also do something that's a little bit different. We can take an absolute high and we can measure how far down did the market go, the absolute retracement value. So the value of this swing tells us a lot of things. It'll tell us the strength, how much they were willing to go back up, and as such, the Fibonacci numbers that are 100 or greater, meaning 100, 138%, 161%, 200%, will also create bounce areas. And you can do projections from different swings and get different Fibonacci ratios. And again, it's when you take, raw data and then you do all the retracements and then you do projections and you do more projections, you end up with, a picture. And I want you to think, and again, that was only maybe an hour's worth of data. If you were to take every swing, highs and lows and retracements in the market over the course of 30 days and did every possible Fibonacci projection and retracement from all those swings, what would you end up with? Well, that's what I thought back in 1997. And this is where I created our Fibonacci algorithm. And I created this software so it will do all the calculations over 30 days worth of charts. It will create synthetically higher time frames and do Fibonacci calculations from all 10 time frames. And then more importantly, remember what I said about the bigger numbers? You have to assign a weighting hierarchy to each projection and retracement because, again, some of them are more powerful than others. And the other really, really endearing characteristic of Fibonacci is that because it's determined the support and resistance levels from absolutes, new absolute highs, new absolute lows, Fibonacci support and resistance that's automated will always keep up with the current market conditions. Higher volatility, lower volatility, and because it's only measuring raw data, it doesn't care what market it is, whether it's crude oil, the S&P, whether it's the Dow Jones, gold, Forex, cryptocurrencies, doesn't matter. Fibonacci's dynamic support and resistance, our software will work on any market that is liquid. So no matter what you want to trade, you can use our software on it. Once complete, our software is going to highlight the best areas. So just to give you, this is just for a laugh. This is the raw data behind the scenes on a 5-minute chart. And again, it's untradeable, it's unusable. And the beauty of our software is that all that filtering and algorithms, this is what you end up with as an end user. You have red horizontal lines that go across your chart, which can become resistance. You have blue horizontal lines that run across your chart, which can be support. And we also use a 55 period moving average, which can be green if it's going up or magenta if it's going down. And those are really, those in addition to the yellow dots, which is the Fibonacci 100% alternate. Those are the support and resistance areas that we're going to look to either buy or sell. So if the market's going up, we'll buy support. If the market's going down, we'll sell resistance. And again, we're going to go through this and take a look at it. Conceptually, we're able to use the synthetic time building portion of our software, and we can plot or display multiple time frame fibs from other charts. So we use 3 charts traditionally. Some people use a 4th. And we can display the Fibonacci support and resistance from all of those charts on a single chart. And the one thing that I want you to think about is that sometimes support holds and sometimes it breaks. And this is where we really set ourselves apart, because we know with a very high degree of certainty that this one will break and this one will hold, or this one will hold and this one will break. And we'll get into it, and I'll show you very simply in our trigger lines how we're going to accomplish that feat. So our T3 trigger lines, you're going to spend a lot of time, and remember our first study thing that we're going to do is reading fibs and triggers. So when you're reading the support and resistance areas and you're reading the trigger lines and doing it properly, you're going to do very, very well with your analysis. So there's 2 trigger lines. They're both the same. One of them is a 20 period of the market, and then one of them is a 38 period, so it's a little slower. We call them affectionately the small triggers and the large triggers. Pretty easy, right? Large triggers are a larger number. They're dotted. They have the black lines in them. The small triggers are the faster that move with the bars, and they're solid. Now, these trigger lines have some characteristics that make it very successful for us. If the small triggers are up, meaning crossed up, meaning green, and they're physically above green and crossed up large triggers, especially if they're widening, then the odds become very favorable in the short term for the market to continue up. And then the same thing is true in reverse. If the small triggers are physically below the large triggers, and the large triggers are crossed down, in the short term, the odds of the market continuing to the downside are enhanced greatly. And then, eventually the small triggers will get inside of the large triggers. And this is where, think of it this way, anything can happen. So if you're going to take a position or you're going to exit a position, this is the spot to do it. Again, remember the Chicago Mercantile Exchange Group. And again, not that they're endorsing Nexgen, and I'm just using them as an example. They did make almost $5 billion last year, so I think they know what they're doing. I wanted you to see what they think is important. He who fails to plan is planning to fail. Winston Churchill, right? Traders who win consistently treat trading as a business. It's not a game. It's not something you can play with, and it's not something that comes extra easy. It's a little bit of work. There's no guarantee that you're going to make money. However, developing a trading plan is crucial if you want to become consistently successful and thrive in the trading game. Every trader, no matter your experience, needs a plan. Why are you here? I think it's very profound when you start off with the people that made almost $5 billion and they say you need a plan. They say you need an objective. They say you need a methodology. They say you need risk management. They say you need a trading strategy. And they say you need to keep a trading log. I didn't say it. They said it, but we've done it all for you. So you don't even have to come up with any of these things. You just have to do them. So, again, you're watching this video right here, the indicator basics right now. And you're going to learn primarily in the beginning trend trades because they're a heck of a lot easier than any of the other trades. Trend trades first, they're the easy ones, they're the obvious ones. You really can't mess them up when the indicators are right. We have videos on trade management, and then we also have videos on trading the edges, which you will work on as you're learning. Again, one of the other things that they also say, which is very important, is keeping a trading log. Well, we've put together a trading log for you, which you can download, save your own version of it. Not only do you practice on simulator and do market replay in your trading log and capture pictures of all of your trades, but we've also put little cheat sheet pictures for you in each of these links. The best look for the triggers, what does it look like before a winning trade, what if this, what if that, management ideas that we've talked about in the live class, chart reading things, which we're going to go through a lot of that now, when to stop taking trades on your small chart, and then ultimately our volume analysis and some of the ins and outs of how to use that. So again, I want to refocus your attention for just a minute. Learning the trigger line and Fibonacci reading is the most important thing because that's when you know it's okay to take a trade. Period. If you don't get this one right first, everything else is going to crumble below it. So it's very important, and we're going to spend a little more time on Fibonacci and trigger line reading. You must simulate your trades. Don't trade live money. Everybody's going to fail who trades and they don't know what they're doing. You're going to simplify what I'm teaching you into a little plan for yourself that'll be nice and easy for you to understand. After the class, you'll be able to replay the day so you can not only trade during the day, but you can go back and fix your mistakes, right? Fixing your mistakes is just like a professional athlete or golfer or anything else where you don't just play and do a poor job and then go away and hope it's better next time. You have to go practice and fix mistakes. Repeat this process every day until you can guarantee yourself you're going to make money. Now, the other added benefit of what you have is we have a live class. So I run a live class every day between 9 and noon, and it allows me to teach lessons live as they're happening, but also to give you feedback on the trades that you've taken, and that's really what's very important. So the first trade you're going to start off with, and again, we have a dedicated trend trade video, but I'm going to give you the basics here as well, because the more you learn and the easier it will become for you to see the obvious. When we do a trend trade, we are going to use our trigger lines, again, we've talked about this already, to determine the odds of a Fibonacci area holding or breaking. If the trigger line suggests that there's at least a 75% chance that Fibonacci support is going to hold, this will be our buy signal. And then, depending on where the next resistance are, the conditions, $200 or $300 is a typical win for us in crude oil or the S&P. The idea is to not risk much more than $100 to make $300 and to have a winning percentage that hovers around 75%. That's the way you put together a winning strategy. And again, it's going to be very simple. You're going to see it. It's going to be obvious. You will understand this in a very, very short period of time. Watch. Remember our trigger lines? If the smalls are up and above the large that are up, the short-term probability is that the market is going to continue up. If the small triggers are below the large triggers that are going down, the short-term probability is that the market is going to go down. Again, this is the same thought process, a little different chart. If the small triggers are above the large triggers, it's going up. If the small triggers are down and below the large triggers, it's going down. And I threw this one in here because this little wrinkle right here scares some new people. The small triggers can cross up as long as they don't get above the large triggers going down. So again, this one's obvious and easy. They're both up, they're both down, very easy. This is one teeny tiny little wrinkle right here that a lot of new people get nervous about. They're like, oh, the smalls are going up, I can't go short. Not true. As long as they are physically below, so think location, 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 is just as important as direction and strength. So up, down, down. We don't know what's going to happen because they're inside. Remember, anything can happen. And then obviously up, up, up. So think about our buy signal. We want our direction and our momentum quantified using the triggers to generate odds of success. With sufficient odds, we're going to buy at a support area and we're going to sell at a predetermined exit of number of ticks or an area or a condition. And this is how we're going to generate a profit, by knowing where to get in, where to get out, and why. So look, this is a real chart. And I want you to, number one, in order to do a trend trade or a buy signal or long, first use the trigger lines to define odds. So when you look right here and you look at the small triggers are going up strong and the large triggers are going up strong, that means that you should place an order at support to go long and make money as it trades up into resistance. That's it. I mean, that's literally it. Both triggers are going up. You're going to buy support. You're going to exit with a profit up here, and that's it. And really the key to this whole concept is that on the bar before it goes down, remember what we said about the bar structure? 2 ticks up, you make a new bar. 2 ticks up, you make a new bar. 2 ticks up, you make a new bar. So you're really trading on the high of the bar when you make a new bar. So the trick for us and for you to be successful is to buy low. Well, price is up here. So you're going to place an order down here anticipating that if it pulls back to support with these 2 triggers going up, you are going to make money. It's not a guarantee, but the odds are definitely in your favor. When you think about doing a sell signal or a short trade, you're going to do the same thing. You're going to quantify the direction and momentum of your triggers to generate favorable odds. With sufficient odds, you're going to sell at resistance on the way up and hopefully buy it at support or a predetermined exit on the way down. And again, this is what it looks like in the real world with our software. So in order to do a trend trade short, first look at your trigger lines. That helps you define the odds that are favorable for a continuation to the downside. So the small triggers are going down strong below the large triggers that are going down strong. Smalls are below the large, which means you're going to place an order to sell or go short at resistance. And remember what we said about the bar structure. 2 ticks down, new bar. 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 So down at the low, and again, this is the key concept for you. Remember we said buy low, sell high? Well, to sell high, you have to be able to anticipate where high is going to be. So you have to do 2 things. You have to define your triggers that says we're going down for sure. And then you have to find the corresponding resistance that agrees with the odds of the triggers. And when you put those 2 things together, you get a short trade here, let's say 46.40, that goes down and hits support. This move right here was a $400 on 1 contract move. That's literally your whole day's worth right there. Sometimes that happens in 10 or 15 minutes. Sometimes it happens 12 times a day. We're going to have a lot of fun with what we're doing, and hopefully you can see how easy trend trades are when everything is in your favor. Now, there's a little more. And another important concept is, and we talked about it before, some Fibonacci areas will hold and some will break. And for you to have consistent results day in and day out, you're going to have to require that you see consistent probabilities. And again, this is where we're going to teach you what should happen and why. And when you look at a chart of resistance, if the triggers do not exceed or break above that resistance, you're going to anticipate that the resistance will hold, which means you won't go long and perhaps you may do some type of edge trade short. Again, we were talking about trend trades, but now we're talking about maybe tops and bottoms. And then when the market goes down, if you hit support, but the triggers do not break below support, again, location of the triggers, you start to anticipate, at least don't go short anymore until it either breaks or it reverses. And if it does reverse, obviously you start going long and making some money. And you're going to also see where you're going to get to a Fibonacci resistance and the triggers are going to exceed the resistance. Normally, this is going to cause the market to continue past the Fib. So if the triggers don't exceed it, it'll hold. If the triggers do exceed it, it may break. And if it does, support and resistance will change state. So if it was resistance and it breaks above by a couple bars, it'll turn into support. And if the triggers are going up, you know what to do at support, don't you? All right, so let's take a look. Again, this is building all of the parts and pieces that you're going to need to be successful. Support and resistance lines, or all of the horizontal lines on your chart, are support or resistance. In addition to the support or resistance, remember, this is called our mid-band, and it's simply a 55-period exponential moving average. So, again, those are the two core components, supports or resistances. When you do look at your full chart setup, there's going to be a little bit more. And again, I don't want to confuse you too much. Because again, it's really important that you only focus on the information that agrees and you're ignoring anything that doesn't agree. But just to give you the anatomy of a chart, what you're going to see on a chart at any given time is a negative number with a magenta line or cyan line, and these are called divergences. And again, in class and in videos and with the trend trade video and with the edge trade video, we're going to teach you how to use these magenta lines and divergences to be able to sell the top of Fibonacci if the triggers don't break it. And then if the triggers cross and start going down, we're going to teach you how to do trend trades. And, so again, support and resistance are the red and blue lines. The yellow dots are 1-to-1s, which is just a Fibonacci alternate. So it can be support or resistance. And the negative numbers on the chart are going to generate divergence. And again, divergence, we'll talk about it a lot more in our trend trade video and our edge trading video. Let's just take a look at some, these are some snapshots that we did this week. Obviously, we had the coronavirus thing going on, so volatility was really high. But we managed to capture a lot of very good educational pictures in our class this week. And again, it really just highlights the key thought process that you're going to need to have as a new user of Nexgen when you look at your chart and you're learning what to focus on. And this is probably the harder part for people until you get it, and then it's really easy and you're gonna be like, wow, I can't believe I didn't get it quicker. Ignore the lines that do not agree with your fibs and triggers. So again, it starts with the state of the trigger lines, and the small triggers are up and they're above the large triggers that are up. So since the odds are we're going up, the only line that you pay attention to is this one right here. Because you're going to focus on the areas of support or resistance that are supported by the strong triggers, and you're going to use these areas as entry points. So you're not going to worry about resistance. Remember what we said about the small triggers getting above resistance, and it usually breaks? Well, it got above way over here. So since it got above over here, and both of these are strong, this is the area where you're really going to focus on. And you're going to focus on this area breaking and maybe the market going a little bit higher. So in this one instance, I mean, it took about 7 minutes right here, but the S&P went from 32.26 up to 32.33, give or take. And again, that's 7 points times $50. That's a $350 move in a matter of minutes. There's been a lot of them, obviously. But again, the most important thing, and again, this is an advanced concept that you need to learn quickly, so I'm not holding back. Which lines do you ignore and why, and which ones do you pay attention to? Because if you let all the lines bother you, you're going to have a hard time seeing the forest through the trees. So again, just to reiterate, triggers are up strong, look for the support. Same thing is true here. Look at the lesson. Triggers are going down, so you pay attention to the resistance. And again, this is a lesson that I like to use a lot in class because look, this Fibonacci resistance right here is the same as the Fibonacci resistance over here. The difference is, the winners are focusing on winning looks with the triggers going down at resistance. Gamblers try to sell resistance when the triggers are going up. So the number one most important thing for you, especially if you're doing trend trades, no going short, no selling if the trigger lines are going up. That's pretty easy, right? Sell resistance when they're going down. Don't sell it when it's going up. And again, one of the other concepts, remember what we said about the small triggers being inside the large triggers? Well, if that happens at Fibonacci support, guess what's going to happen? All right, let's look at some more examples. And again, Fibonacci and trigger line reading is the most important concept in what we do. That's why I want to really spend some time with it early. You may have to rewatch this video a few times. But again, we do this in class all day, and once you get it, it's like reading a Dr. Seuss book. It's very, very easy, very simple. Triggers are going below, so the resistance areas of Fibonacci and the magenta midband are going to work to make the market go down. As the market continues down, Fibonacci resistance areas, and again, we're not talking about exact trades yet. We're going to get to that in our trend trade video. But recognizing that you're reaching Fibonacci support and your small triggers are inside, which means you're running out of steam. So if you were going short, this is where you'd start taking your profit, and you would wait to see if the market rolled up from support or if the market broke support. I wanted to add this one in. It's a tad bit exaggerated because of the ridiculousness of the S&P move here. But again, the focus on the correct trigger line look and ignoring the lines that are not in agreement with your trigger lines. So yes, we have resistance up here, but the trigger lines say support is going to hold. Yes, we have resistance up here, but the trigger lines say support is going to hold. Again, as I say, this is a tad bit exaggerated because of the ridiculous, this is 40 S&P points, which is, so much ridiculous. That's so much money, it's ridiculous. And again, we had great volatility, but I want you to see the concepts in action. When you hit Fibonacci resistance over here, if the triggers are below the large triggers, resistance holds. So this resistance and these two triggers actually agreed. These supports and these triggers agreed, so this is where the money's made. Again, just here's a bigger version and a more simple version to see. When the triggers look like this, small triggers down below the large triggers, the resistance area, and sometimes it's only the mid band, sometimes it's fibs and mid bands, but we have a very high probability that the resistance is going to hold. And again, when we talk about entry management and things of that nature, this is the type of spot with the type of look that you want to be assertive and you want to sell on the way up into that area. Let's take a look at some more fib and trigger line reading. So again, this is all from this week, and again, some very good lessons. Notice that we hit fib support. Well, fib support is okay, but the triggers don't agree, so we don't worry about it, right? So when you hit support, you're not going short anymore, so you have to kind of wait. And then ultimately, we reach the edge of Fibonacci resistance in our magenta midband, and the triggers agree. The small triggers are below the large triggers, which means that this resistance is going to end up winning, or has a high probability of winning. And again, when it starts to look a little messy in the beginning until you get your reading of the fibs and triggers down properly. Triggers are down, fibs are up, don't do anything. Triggers are down, fibs are down, now you have a trade potential. And then the market goes down. And again, this is 32.90 down to 32.81. It's 9 points. That's $450 worth on the S&P. That's a lot. Obviously very volatile this week. Now, when we reach a fib, you have to know what to do. So you wait. And one of two things is going to happen. The triggers are either going to roll back up from the fib or they're going to break. And if the triggers break, you're going to sell pullbacks to resistance again. And again, we don't know what's going to happen. We don't need to know what's going to happen. What we need to know is, what do the triggers say? What do the areas say? And when they agree, we end up with a trade. And then we make it down to support. You can see the triggers are breaking below because they're strong, and then more sells. This is repeated over and over and over. That was the spot. Sell, sell, sell. Then you get to support. Again, this is the first time where you get to support. And again, it's a very extended trend. Just because the triggers don't break doesn't mean we're really going to go long. Right? We're going to wait for areas to break or the triggers to roll up, one or the other. And again, if you break through fibs, we just keep selling and selling, or buying and buying as the day goes. The reason I've put these in here for you are because these are all the things that you're going to spend months and months and months figuring out, or you can figure it out inside of an hour in one video and go back and study the concepts. So again, it seems like a lot for the first video, but you need this stuff and you need it now, and the sooner you learn it, the more money you're going to make faster. So, no counter trend trades when the triggers are in a number one look. A number one look for the triggers is the small triggers are going up and they're above the large triggers that are going up. So this is where a lot of people have their failures. They're trying to sell resistance because it's a great area. It looks great. The problem is the triggers are horrible for going short because the small are very strong above the large. And when you see it, you're like, it's obvious. So in this situation, it's better to wait for a breakout to the upside. Or it's better to wait for the triggers to roll, which means you have to wait for one of those two things to happen. And again, there's just because you reach a fib or just because you have a trigger condition doesn't actually mean you have a trade. But again, it's a subtlety, and I wanted to point it out because this is where a lot of people will have failures. Strong triggers, small triggers above strong large triggers. Resistance isn't as expected to hold. Now, this looks very similar, but it's different. This is Fibonacci resistance, but the triggers, the small triggers, are physically inside of the large triggers. And when the small triggers are inside of the large triggers heading into resistance, this is where you start to anticipate that resistance may actually hold. So hopefully if you were long, you would recognize the small triggers inside the large, and you would take an exit at resistance, and then if you had a counter trend trade set up, you may go short. And again, look at the, already in this picture, 50.18 resistance with the small triggers inside has already bounced down to 50.04. So it's already gone down 14 ticks. And again, it's a subtlety. Small triggers above the large, no going short. Small triggers inside the large or below the large, maybe you have a better chance at Fibonacci. So let's take a look at, again, this is a full picture from a real day, and I want you to be able to see it. Small triggers going up strong, well above Fibonacci, you're going to do a long trade and make some money, hopefully. Then when you reach Fibonacci again, we have to think about where are the triggers and what are they doing. Well, the small triggers are physically located above the large triggers that are going up, which means Fibonacci should hold, which allows us, to do edge trades when we anticipate the edge of Fibonacci support to hold and take us up to resistance. Then when we reach resistance, we have to do two things. Number one, where are the small triggers in relationship to the large? And then number two, how many triggers broke above Fibonacci resistance here? And if the answer is inside and none of them broke, then resistance is probably going to hold, and maybe there's some short trade opportunities. And then, edge trades at the edge of resistance. And then obviously when both triggers are going down very, very strong, smalls below the large, it's very easy to see you're going to do a short trade down to support. And then when you get to support, the triggers are going down. Notice, look, over here at the fib, they're going up and they're above and up. So we get winners. And then when we have the same fib but different triggers, this is where we have to wait for a break of the fib to turn into resistance, or the fibs to actually hold and then the triggers to roll up. And again, you'll see this concept time after time after time. And again, there's a lot going on over here, but none of it matters because none of it agrees. And only when the triggers are right and the area lines up with the correct trigger line look are we able to focus in on the correct spot where everything is involved, if you will. Right? Large triggers going down, small triggers going down. Look for the resistance. And then, you see the triggers get inside and the market goes the other way. And again, there's a whole lot of stuff that happens here that doesn't have anything to do with us because the areas are down, but the triggers are up. So we're waiting. And then all of a sudden the triggers are up and the areas are up. And then we get our easy trade. So there's only two trades on this entire chart. There's one short trade here where the fibs and triggers and everything agrees, which again, 33 down to 23, and it's 10 S&P points, $500. And then, 33 up to 40 is 7 points. I mean, that's way more than a day's worth of profit. But the important part to this is that while there's a lot of lines and a lot of movement, there's only one trade. And while there's a lot of lines and a lot of movement, there's only one trade where the areas and the triggers agree. And you'll see this concept over and over and over. When you reach a Fibonacci resistance area and or a midband, you have to have some type of expectation by looking at your trigger lines. And when your large trigger lines are so far away from the resistance that there's no way it's going to break, and your small triggers aren't going to break resistance, we can anticipate that resistance is going to hold. So if we have a reason for a short trade here, obviously we're going to take a short trade. Now remember what I said, comparing the same resistance but having a different trigger line condition? So the triggers are, even though they're up, they're so far below that we anticipate it to hold because they're not going to break above it. Over here, look at, it's the same red line, but the triggers are all wrong. So what we're waiting for is we're waiting for a breakout and the triggers to be up and then to have some blue support so we can take a long trade. Again, there's a lot of waiting and trading. Waiting for the fibs and the triggers to agree, and when they don't, waiting until they do. Again, same situation here. Small triggers are in between the large, so we end up making a little bit of a bigger pullback. But we pull back to the green midband and blue support area, and we have to then read our trigger lines. Remember what we said about the large trigger lines being really far away, especially if they're already past the fibs? Well, this support is anticipated to hold. So again, if we have an edge trade on our smaller charts that gets us in, we get this long trade over here. And then look how easy. They're all going up, support agrees, we get easy long trades. See that? Triggers are up, support agrees. That's what we're looking for. Let's look at a couple more charts here and then we'll be done with this. Look, triggers going down, resistance agrees. Triggers are inside, support doesn't agree. Eventually the triggers agree with support and look what happens. And then the market gets back to support, and again it's the same look as we had before. Large triggers are up, small triggers are above them. Anticipating support to hold is a powerful tool for doing edge trades to go long to get up to resistance. When we reach resistance, we can say with a high degree of certainty that it's not anticipated to hold because the triggers are so strong and they're breaking through. Same fib area over here, different triggers. This one makes you rich. This one will make you poor. Don't sell when they're going up. Sell it when they're going down. Again, same situation. Strong triggers at resistance, but they're a mismatch. So we don't do anything. We wait and wait and wait, and then eventually the triggers and the support agree, and we have an easy trade. And then the market makes a retracement. And again, this is where, this one on the left is easy because everybody can see it and everything's the same color and everything's nice and easy. That's a trend trade. This one is an edge trade. And again, when we reach the edge of Fibonacci support and our divergence lines, we have to then say, where are the large triggers? How far above the Fibonacci area are they? Is there any chance that these triggers are going to break the support? And if the answer is no, and again, the farther away the large triggers are, the better, we can take this trade right here and go long and make a bunch of money up to resistance. And then when we get to resistance, we have to read our triggers, and if they're really strong, then we just wait and see what happens. Again, you could do this, go back over your charts and study this, and it'll start to become very easy. Small triggers down below the large, resistance holds. Strong triggers down, the midband holds. Break support, strong triggers, resistance holds. Strong triggers, sell a pullback. Strong triggers, sell a pullback. Eventually, the market's going to turn around. So, you may take a loss, or on the smaller charts, you may have a management of that. Again, we're not going to get into that in this video. I want you to see the easy concepts. The triggers are up and the support agrees. This is where you're going to get rich. The triggers are way beyond and way above the fibs. The fibs are going to hold. If the triggers are strong, you're going to buy a pullback. If you get to resistance and no triggers break through, you're going to get a reversal. And again, you can do this a million times over and over. And when you study it, look at the fibs and look at the triggers. It's going to hold. Look at the fibs, look at the triggers. If you're not quite sure, wait for the triggers to roll, and then you'll get an easy trade where the resistance area and the trigger lines both agree with each other. You go short here at 39 on the S&P, and you get out over here at whatever it is, 32. That's 6 points. That's $300 easy right there. Just that one little move. And all you have to do is wait for everything to be going down and then sell the resistance. And then when you get to a fib, if the triggers don't really break through, you have to wait for either the fib to break or the triggers to roll over. Same thing. Fibs, wait for the triggers to agree. Triggers agree. If you get to the fibs and the triggers are inside, it may hold. Again, I'll let you go through and you can study these, but it's the same thing. If you hit a fib and the large triggers are far away, the fib will probably hold. If the triggers are going down wide, you're going to do some type of short trade. If the triggers are going up really strong, or if you get to a fib and the small triggers are above the large triggers going up, the fib's probably going to hold. If the small triggers are inside of the large and they don't break the fib usually holds. If they're both going down wide, you're going to get a short trade. If you get to Fibonacci support and the triggers don't get below it, it's probably going to go the other way. If you hit fib support and the large triggers are far away, it's probably going to bounce. If you're not quite sure, you just wait for all the triggers to be going up really strong and the support to agree, and then you're going to end up at the right trade. And then when you go long here and you get out at fibs, you can say my triggers are inside. They didn't break the fibs, so I have to wait until everything agrees again. And again, when you start building in the smaller charts, so you're going to go to the trend trade video and you're going to start building in smaller charts. Again, I wanted to really highlight the large and small triggers for you. Again, at the lows, you're going to see the right spot to go short. And then as you're making money, I think this was 20 and 24 ticks. That's $440 on 2 contracts right there. Because the triggers are weak, it's going to make a higher retracement. And then because the triggers are so far away from the edge of resistance, if you were inclined, this would be your spot to go short. As you start to bring in all 3 charts, and again, this is probably a little bit too much for you on day 1, but you'll start reading your triggers on your 14-2 chart and knowing you should take longs. And then as you start to manage, you'll start using some of the smaller charts to get in, get out, get back in again, get out. Then when the triggers are going strong, you're going to get in. And then when the triggers are weak, you're going to get out. And you're going to really have a very comfortable, very confident read of your indicators. And more importantly, again, you've just learned, but you're going to have to really spend a lot of time studying this so you can be very comfortable with the right look. You will end up with unimaginable consistency when you have the correct areas and the correct trigger lines that are in your favor. You're going to have consistency, accuracy, and a lot of profit potential, and you're going to get it very, very quickly. And again, this is the plan that we've laid out for you. We talk about it in class. We have it on the trade log sheet. We encourage you to do trades and participate in class. Make sure that your fib and trigger line reading is correct. And we look forward to welcoming you to Nexgen and teaching you how to make a bunch of money using our Fibonacci software.